Well, good morning and happy Thursday as we get Facebook up and running. Wanted to start out with our quote. But first I just wanted to say, as it starts to feel a little bit more like spring, Megan and I went to the Hilt today. We went a little color.
We are razzly dazzly today. I woke up, I needed to wear it. So I have a yellow coat that I'm wearing over the top of this. This jacket has a little bit of yellow in it. I was like, I need color today because it has been so gray and so cold that I need to have color on me because I'm getting into this all black rut as we get deeper into the winter months. And I have to have color. So I was like, I'm going for it today. I've got silver shoes on.
And we
totally
usually coordinate better. You didn't use the bat phone this morning.
I did not.
Although
I
I'm
just
digging
went
the
for
shoes.
it. No, and I woke up super early this morning, so I was like, I gotta put on something razzly dazzly just to get going for the day because I've been up since 2:15, and so I threw in the towel at about 2:15 when I couldn't sleep anymore, and was on my computer and working by 4. And so I was like,
I didn't get an email.
No, I did not send you an email. I did not send you the early morning club email this morning.
I got a text at 4:45 though. I did.
Gosh.
And I was like, people know.
Yeah.
And I just responded. I was back at it.
Yeah.
But I was feeling the same. I was like, the sun is shining. I know it's going to be like 1 degree is the low next week. But it snowed yesterday.
So
I'm feeling really good. Went for the color. We got the color back here. I think we're clashing though at this point.
This is a little bit much. I can just take off my jacket and just wear the white top if that helps.
No, I'm digging the clash. At this point, we're going to own it.
We're just going to go for it.
So we've got so much to talk about today. I know that everybody's kind of curious as to what the market is doing. There's a lot of buzz, a lot of activity. There's definitely conversations happening. Is it turning into contracts yet? Is it turning into deals? And slowly it is.
It's gaining momentum.
It's gaining momentum,
which is good. This is what we want to see.
I mean, it's January, for crying out loud.
I know.
So we don't want the January that we had in 2021 and 2022.
No, we don't. That was crazy.
It was. So we're ramping up. We've got the buzz already. We'll go ahead and remind everybody, we don't have a market update next Thursday.
No, we have the next big thing next Thursday. You better be there.
We have the next big thing. So we will not be on Zoom nor on Facebook Live. I'm sure we'll be going live throughout the day on Thursday, but not specifically with the market update. And then in the news, there was a lot of, on the economic side, there was a lot of information that was both positive and negative. It really is one of those moments where I think we're hitting that turning point in both the real estate market and the economic market. And I don't think it's going to be immediate. I think it's going to be this like back and forth where we start to have good news and then it backs up a little bit, and good news and it backs up a little bit. But this is why this is so important.
Yes.
Right? To know what are the triggers this week that's causing the headlines that my clients are reading, which is why we do what we do and why we love doing what we do. Okay, give our quote.
Yeah, let's go into the quote.
All right. So I went with a kind of a simple theme because of the fact of having good news, bad news, good news, bad news. And I don't think it's going to end. I think we're going to talk a little bit. The Fed is meeting on January 31st and February 1st. So we'll get that next quarter Fed rate hike next week. And we're still going to, leading up to it, and during that, we're going to have inflationary news that sounds good. We're going to have economic news that doesn't do well for our bond market, and all of these things, and trying to figure out who are the people that want our help and how do we help them. In fact, I taught a DMAR class. What is today? Today's Thursday.
Yeah,
what am I doing? This is the longest week of my life.
Well, it's flown by, and it's been long all at the same time. It's been a very busy week.
Oh, so I taught a class on Tuesday at DMAR, and one of the lovely participants that were there in the room was talking about the fact that she's got these clients that keep talking about the bubble.
No,
and I keep thinking that
like kryptonite horror. I can't have a conversation for 9 years.
I feel like it's over. Shouldn't we be going?
this should not be having, we should not be
No.
having this conversation.
No. And she's still having it, and she still got clients sitting on the sidelines. And, we went through kind of the statistics of why the housing market, the equity and the low foreclosures and the wealth that we have in our households. And ultimately came down to, you can't help everyone.
Yeah.
And you got to focus on the ones that you can and have the conversations where it's being received. So that's where my head went when I found this quote. Don't forget that you might be the lighthouse in someone else's storm. You have to find those people that are reaching out to you, receptive and open to the conversations that you're having. You do good work. In fact, in my humble opinion, I think that the work you do as real estate agents, the work that you do in the title industry, and the work that I do as a lender, the work that we do is more important than any financial planner. And I said this yesterday at a Berkshire Hathaway meeting, and I was so blessed to be a part of that. But I do believe in my heart and in my soul that we do the kind of work that changes the trajectory of lives. But you can't change the trajectory of a life if they're not even open to listening.
Mhm.
So you have to go, and it's that endurance marathoner who's the recovery period. Your recovery period has to be so fast that you have to get rid of that bubble talk and move on to the next person who is open, because you do have lives to change. You have trajectories to affect, and you have wealth to create, both for yourself and for your clients. So be the lighthouse in someone else's storm, and let the rest go to the side.
Mhm. Very
Right.
good. I love it.
Yeah.
I love it.
So what is going on in the market?
This weekend, it wasn't as busy as the weekend before in
Interesting.
terms of
Okay.
showing activity.
Okay.
And so I think that we're all kind of stuck in football season
But I
right
was
now.
going to say it was playoffs.
And so
I
we've
wasn't
got
paying
playoffs that
attention.
have been going on these last 2 days. And
Yeah.
I was running around doing other stuff. I didn't watch football until Sunday night. But there were a lot of people that were hunkered down watching football this last weekend. So there wasn't as much showing activity this weekend as we saw last weekend.
Yeah.
Now, keep in mind that we're only a couple weeks out from the Super Bowl. And once the Super Bowl is done, we've got President's Day weekend, and the market's going to pick back up unless you're in one of those super luxury price points.
Okay.
Then I would say to wait one extra week before you list your properties, because those people that are super luxury, let's call them the over $2 million
Mhm.
people, they've got their second house in the mountains that they're going to, and
And
they're
they're
headed out
skiing.
skiing
Yes.
for the 3-day weekend. And so the lower end market ends up taking off like crazy
Mhm.
the weekend directly following the Super Bowl. And you've heard me say this about a million different times to you guys. And I just want to make sure that I hammer it into you that that's really the seasonal kickoff for our market, where we see showings and pending transactions increase by 30 to 40% over the previous week. And so really that's the kickoff to our season. Then we continue to gain momentum through March, April, and May. We hit our
Right.
peak. And then in June, we start to pull back as people start to go on spring break and buyers fatigue, and they start to renew leases.
Yes.
And we start to see people pull out of the market at that point. But we are about to be in the portion of our market where the rubber really hits the road, and we are going through what's called a compression cycle again.
Yeah.
Due to the way that the market ended last year being so quiet at the end of the year, I wasn't sure if we were going to have a compression cycle. Now, a compression cycle exists when you're putting more homes under contract than there are homes to sell people. And
Okay.
what that causes is rising prices. And so what
Yeah.
we're likely to see in the next couple of months is month over month, we're going to see prices going up month over month. And I'm hearing multiple offers again.
I am too.
Now, I've also heard that there are multiple offers that are going for under asking price, and I have no way to measure those, but I can track the ones that are going for over asking price. We're starting to hear it come up more frequently, and we're looking at that in our month supply of inventory on a consistent basis to see what those numbers look like, to see if it warrants multiple offers. And there are definitely some parts of town. I should have brought over my heat map for you so I can show supply of months in the heat map broken out by zip code with my little map of C470. But really along the south side of town, from like Centennial over to Highlands Ranch into the Littleton and portions of Lakewood, Arvada, Westminster are on fire, North Glen and Thornton, and then the corridor along 225. So it's these inner landlocked ring suburbs right now that are below 1 month worth of inventory that we're seeing a lot of these multiple offers in right now. versus if you go out just south of the airport in North Aurora, there's a lot of new construction there that's competing against resale at a similar price point. That market's lagging. They've got like 4 months of inventory out there. Lodo's a little bit slower. We've got about 5 months worth of inventory in Lodo. And then getting down into Elbert County, we're back to 4 to 4.5 months worth of inventory. So those are some of the slower portions of town right now. You can catch those maps in my detached single family market update or attached single family market update. As a reminder, we email all of this stuff out to you guys at about 11:30 in the morning, right after we wrap, and we get the copy of the recording back. I send you out a copy of this recording and all of the reports for the last week, and you also get the monthly and quarterly appreciation maps in there as well. So you get copies of all of that. We've already got a couple of questions. Let's see what these are. Chaotic clashes, the Gen Z fashion aesthetic, ladies. Yes. We are definitely nailing that today. Good morning. Curious, Nicole, are you still doing any lease buyout help for clients and buyers?
Yeah.
Meeting with a client today that is in a lease until summer, but I think she'll be better off buying earlier than later this year, i.e. February, March instead of April, May, and June.
Lee, give me a call. Let's do it. Absolutely, we are.
Awesome.
The more people we can get into home ownership, we know what an impact that has. And if that is the thing that tips them over, then it's absolutely the thing that makes the most sense to do. And it's interesting, going back to what you were just talking about, very specific to areas, right? And there are certain areas that are becoming, I don't want to say popular, but they're more demand is being hyper-focused locally on certain areas, because we're coming into the beginning of the year and theoretically our inventory is similar to what it was in 2019. And it is just slightly below that. So we're back into this period of normalcy, yet a lot of that inventory was carried over, and maybe it's inventory that that it just needs to be taken off the market, rehabbed, and then brought back on the market, or whatever the situation is. But then the inventory that is, you're finding because of that localized demand, we're seeing that compression already. We're seeing the prices going up already. We're going to see the stability. It's going to filter over to the rest of Denver as those buyers, if they can't get into the neighborhood they want, do they start looking at other neighborhoods at opportunities for maybe it's my first home that I'm going to turn into my first rental, and to change a conversation.
Yep.
But this year, inventory will be the topic you and I will be talking about all year.
Well, and I've had a lot of conversations about the notion of a balanced market, and we'll talk more about this when we get into my slides. But when was the last time we saw a balanced market? Probably towards the end of about 2012, early 2013 is the last time that we saw a balanced market. And we shifted very drastically into an extreme seller's market by the time that we were in full mode for 2013. And so looking at my projections going into 2023, I'm relying a lot on data from 2013 through 2019. We're returning to that normal seasonal cycle, and we'll go ahead and get into the slideshow right now.
And while you're opening that really quickly too, I mean, one of the things based on what Megan is saying is going into that more of a seasonality, and what, you know, after Super Bowl, you can expect this, and in June, you can expect this, and into the fall, you can expect this. And those things are all spot on. One of the other things that we're going to have to be mindful of is, when do the interest rates start dropping? So based on what's happening with the Fed and with inflation, and when we start see the interest rates drop, it's going to add fuel to the fire, add more demand in, and could either create this more cyclical that we've been used to pre-2021 and 2022, or slow it down and create a lower market for the rest of the year.
Yeah, we could see an extended selling season this year based off of interest rates dropping in the second half of the year. And so again, we're kind of waiting with bated breath to see what happens there. Now, this graph, this data represents January 18th through the 24th of 2023. If you guys have the link saved, you've already got the update. I got it done by 7 o'clock yesterday morning because I'm on a roll, waking up between 4 and 5 o'clock in the morning.
You get a full day in there.
I do.
Mean, when you wake up early.
I do.
It's a full day. I love it.
Take about 30 minutes to wake up and drink coffee and watch bad reality TV that I missed the night before because I go to bed so early. I love reality TV. I watch all of it. All of it. TLC is my jam. All right, so looking at our heat map here for 2023, oh no, I've got 2022 in here. I've got to go through and update that. This is for 2023. You can see that we're starting to see some red cells creep in here, indicating that the market is starting to heat up. Again, as you go through, this graph grows through the entire year, and it gets bigger and bigger as I go through the year, and it'll end up looking something like this. But it is growing and it's heating up as we get deeper into our seller month, or our sellers market. Now, big story here is average daily active count came down by 2%. 2.1% again this last week. And active inventory has the tendency to continue to drop until we hit about mid-March when we start to see new listing inventory come on the market. But it didn't help us out this week because our new listing activity was 702 new listings that came to market. That was actually down by 0.8%. But lo and behold, our pending transaction count kicked up by another 6.2% over last week. So our buyer pool is not only getting more active, but they're also getting more serious about putting something under contract. Whereas for the first 2 weeks of the year, they were kind of looky-looing around. Now they're starting to see that other buyers are out there looking, and they're starting to feel that pressure to put something under contract because the market is becoming more competitive. Now, with this shift between the relationship of supply and demand, it drove our predictive month supply of inventory down to 1.1 months worth of inventory. Back here at Christmas time, we were sitting at 3.4 months worth of inventory, and we've just been dropping like a rock. Now, again, if that number drops below 1 month worth of inventory, that means that we go into multiple offer territory again. Now, I don't think it's going to get down to the 0.2 or 0.3 months worth of inventory like what we saw in 21 and 22, but I think that we're probably going to get down to about 0.6 or 0.7 months worth of inventory as we head into the next couple of weeks. The market really crunches down. And so some words of advice for you guys right now is that if you have one of those listings that's not so pretty, if
That's
you
a really nice way to say
not
that.
so pretty, if it has lime green walls, weird floor plans, it's on business rates, get it to market as soon as you can, because you don't want to be competing against all of those listings that are timing the market perfectly for March and April for when prices are really going up, because those listings are going to be cherry and ready to go and turnkey. You don't want to be competing against those brand new cherry listings when they come out. So if you have one of those that's not as show ready, get it to market as soon as you can. Looking at where we are for the odds of selling, it came up very nicely this last week. It increased by another 0.6%, and now our odds of selling is 52.5%. So that's basically where I take into account all of the available listings for sale versus those that go under contract and or close in the same week. And I project it forward for a 4-week period of time. And that is dead on where we're supposed to be for January. Historically, from 2013 through 2019, we landed about a 53% odds of selling. So we're warming up right into where we have been cyclically based off of data from previous years in this real estate cycle, right where we're supposed to be. It's great. Looking at again where we are in terms of balance based off of what went under contract last week, that demand that surfaced, if we were to create a magical 6 month worth of supply based off of what went under contract last week, we would need to have 22,500 active listings available for sale. Now, for those of you that are still out there having the bubble conversation, this is why we're not in a bubble. Okay, we are out of whack in terms of supply and demand, where we only have 19% of a market balance. We need to be north of a 6 month supply of inventory for us to flip into that buyer's market, where we would start to see some of those foreclosures, short sales, and HUD homes start to come out, where we start to see prices seriously decline over time. Now, we have gone through a market correction over the last 6 to 8 months, and that's in light of affordability, but we're going to start to see some of those gains come back again. Year over year, our appreciation might be negative, but prices are going to start going up as we go into the next 3 to 4 months here, and it will continue to do so until about June. Then in July, it stabilizes, and then in August, September, and October, average sales prices tend to fall back as the market starts to retract. But this is what's keeping us out of a market where we're going into a bubble, is because we're too short on inventory, we are too flush with equity, and plus our job market is doing very well. What's unemployment right now? Do you know off the top of your head? 3.5. So again, we're not coupled with that large loss of jobs that causes hardship. So we are not seeing that financial hardship strike where it's going to cause a major loss of unemployment, where we would see people that were unable to make their home payments. And if a homeowner finds themselves in a level of distress right now, they're able to sell their home very quickly and gain back all of that equity that they've earned over the last 10 years in that property. Now, looking at where we are for shows per property per week, again, total showings this week, we're down by about 6.2%. We're all watching football right now, so it might be a little bit slower, but it is gaining steam. It was up last week pretty drastically, and so I was really pleased to see that. We had a 14% gain last week, down 6.2% this last week, but with that drop in inventory in our marketplace, our relative shows per listing stayed high at 2.8 shows per property per week. I was giving a presentation. I gave 3 presentations yesterday on this. 3.
It's been a full week.
By noon. And so when I had one person pop up and they said, what, only 3 shows per property per week? And I'm like, that's what you should be averaging probably in weeks number 1 or weeks number 2 and 3. Keep in mind that in week number 1, that's your week to get that listing out there and to have as many showings as possible on those properties. I'm hearing more northwards of 20 to 25 showings on homes that are under 750 right now in the first weekend. But as you start to average that out over time, we're looking at about 3 shows per property per week. So if you get to a point where you're not getting 3 shows per property per week, that could be indication number 1 that you might need to make a price reduction.
Or if you only have 3 showings in the first week, do you think? Is it a little bit of a?
It might be a little bit too soon to make that judgment call.
But
I
it
would
could
give
be a
it a
heads
little
up.
bit more time, but that could be a heads up that you might not be in your target range. Shows to contracts ended up dropping by 11.7% this last week. Last week, they were looking at about 16 properties before going under contract. Now we're looking at 14. So buyers are starting to feel some pressure to get some units under contract. So that could be sign number 2. If you've had a total of 14 showings and no offers, that might be the sign that you need to reduce your price. Or if you're working with a buyer right now, you're on average showing them about 14 homes before you go into a contract. This time last year, we were bouncing between 10 to 12. We'll see if that number continues to come downwards, but hopefully it starts to come downwards so that, again, people are getting stuff under contract without you having to show as many homes. Looking at average and this is median days on market, the point at which half the homes are under contract is just tanking right now. And so we've got a lot of people that have gone out there and they looked at all of the homes that were listed in November and December. They were waiting for the perfect home to come on the market in January or the end of December. And now that those perfect homes are coming to market, those are getting absorbed very quickly into the market. And so median days on market over Christmas was 51. New Year's, it was 43. The first week of January, it was 36. Now the second full week or the third full week, we're looking at 21 median days on market. So we're down to about 3 weeks for you to get half the homes under contract. So that's sign number 3. If you've been on the market for longer than 3 weeks and you haven't had any offers yet, it may be time to reduce your price. So our market is picking up very nicely. I don't think we're going to get back down here to this 4 median days on market nonsense that we had for the last 2 years. I think that number is probably going to come down to about 14 as we start to get into March, which is still 2 weeks to sell a home, is pretty dang good considering the average over the last 15 years is about 75 average days on market.
75 is the average.
75 is the average.
But is that because of how high it was in like 2008 and 9 and 10?
At one point it was 126 average days on market.
So like if you remove 8, 9, and 10, and if you remove 21 and 22,
I
what
know
would the average be?
Yes. So the average there would end up being for the month of January. It usually comes in at about 34.
That makes more sense.
Yes.
Okay.
But we're still below that.
Yeah.
Okay. Looking at where we were for price reductions, the rate of price reductions has also come down by about 4.5% this last week. Of those that went under contract, only 39.7% of them reduced their price, with 58.4% making no changes to their price whatsoever. For the month of January, we want to see that number bouncing around about 35 to 37% making price reductions. And so again, we're pretty close to where we should be for a normal seasonal cycle based off of data from 2013 through 2019. Looking at the size of the price reduction, it's still a little bit on the large side. We're looking at about a 6.9% price reduction for those units that went under contract this last week, or about $47,500 off of their original asking price. Again, asking price right now, we're looking at around the $700,000 to $710,000 average sales price range right now. For homes up to $500,000, looking at our strategy sheets, you can see that it's starting to warm up. Looking at where we are for month supply of inventory, there's that number, predicted month supply worth of inventory down below 1, sitting at 0.8 months worth of inventory, indicating that multiple offers are highly likely if you're putting offers on homes that are under $500,000 right now. Our average daily active count continues to go down. It's down to 1.8. Pending units in this market jumped by 16.5% last week. So we saw a big push of activity in this market to get things under contract, and it's driven down from 2.1 months worth of inventory over Christmas break, now down to 0.8 months worth of inventory as we head into our spring market. And I think that number is probably going to land somewhere around 0.5 months worth of inventory as we start to really get into our spring market. The odds of selling jumped up by another 0.8% this week at 60.7% odds of selling. So this is warming up nicely. I think a good number for this market is probably about a 70 to a 75% odds of selling as we start to hit March and April. Looking at where we are for percent of balance, we only have 13.6% of a balanced market when we're looking at these numbers. We would need to have about 8,800 total units available for sale in this market to offset demand. Looking at where we are for shows per property, we're looking at more shows per property per week in this price range. We've got about 4 shows per property per week. So if you didn't get your 4 showings, that's your sign number 1 that you might need a price reduction. They were looking at about 14 showings to go under contract. So if you've had a total of 14 showings and no offers, it might be time to reduce that price. And finally, we dropped from 37 median days on market back in Christmas. Now we're down to 17 median days on market. That number is probably going to drop down into the 10 range as we get into March and April, where our inventory is the thinnest. Looking at price reductions this last week, it was about 39.9% of all the homes made price reductions, with 59.2% making no price reduction. And the average price reduction was still on the large side at about 6.5%, or about $28,000 off of their original price. Now the $500,000 to $1 million range, this is really the bulk of our market, where it represents 60.2% of our overall market and our houses. In this market, we dropped from 4.2 months worth of inventory over Christmas break. Now we're down to 1.2 months worth of inventory as we head into our spring months. Again, if that number drops below 1, that means that multiple offers are being driven out again in this market. Our average daily active count continues to decline, compressing our market further down to 2,499. Pending transactions this last week fell by about 1.5%. We can call that relatively flat at that point, but we put about 454 units under contract this last week. So again, we're starting to see this compression phase really take place as we continue into extreme sellers market territory in this $500,000 to $1 million segment. The odds of selling declined week over week by about 0.4%. We were up to about 50, or increased. That number is wacky. I don't know why that number is there. I'm going to have to go back and look at that, but it's a 50%. So it increased week over week by just a tad. We're at 50% odds of selling this week. And so again, that number continues to warm up nicely. I'd love to see that number hit 65% odds of selling as we start to trend into our spring months. I think that's a good benchmark for us. In this market, we're at 20.7% of a balanced market. So we're closer to a balanced market in this $500,000 to $1 million segment, which is our most loan dependent category, with 90% of these borrowers requiring financing to get into these properties. So these buyers are being more discerning about what they're looking at before they're putting units under contract in this particular market. They're looking at it's about 2.5 shows per property per week. So make sure you're getting your 2.5 showings. And we're looking at about 13 showings to go under contract. So that's down from where we were over Christmas break, where that number popped up to about 15.5 showings to go under contract. We're now down to about 13. So they're looking at fewer homes before going under contract. We are now down to 43 median days on market. This number isn't dropping quite like I would like it to. There's probably some excess inventory that was listed back in November and December that's now coming down in price, that's starting to come off the market. But price reductions were about 40.6% of all the homes reduced their price, with about 56.5% having no price reduction. Average price reduction this week popped up. It was a 6.9% price reduction, or about $49,500 off of your original asking price. $1 to $1.5 million. I want to double click on this segment for a little bit because some of these numbers are crazy to me.
Okay.
Then this market, once you go over $1 million, you have about 40% of these being cash transactions. So they don't really care what's happening with interest rates. And what's happened this last week is they really started to come out of the woodwork. And what ended up happening this last week is our month supply of inventory over Christmas was 6 months worth of inventory at a balanced market. We're now down to 1.4 months worth of inventory in this market. So it has picked up very quickly in the first 2 weeks of January this month. And our pending transaction count, our average daily active count fell by about 2.5%, but our pending transaction count increased by 6.1%. And our new listings this week were down by 22.9%. So we didn't have that feed of inventory coming in this market. So again, our month supply of inventory ended up dropping this last week.
So buyers are scooping up what's left on the market, but new inventory is not coming on because they're waiting until after the Super Bowl.
Yes.
Yes.
Yeah,
Legend be.
they are. That's exactly what's happening. The odds of selling ended up going up by about 2.4% this last week. We're now sitting at about a 47% odds of selling, which is where we were back in 2020 at this point. It's actually better than where we were at this point of the year in 2020. And so even during the pre-pandemic years where the market was really starting to heat up, it's getting better. I think that we're probably going to top out at about a 55 to a 60% odds of selling in this particular price range as we get into our spring months. But in this market, we only have 15.4% of a balanced market. So this market is even more out of whack than what we're seeing at lower price points, because again, they don't care necessarily what's happening with interest rates, with 40% of these transactions being cash.
I got to stop you right there.
Yeah.
If you guys don't see the marketing opportunity in this, all of those sellers that might have been sitting on the sidelines in the fall that are in this million to 1.5 price point, they need to be communicated with, because they don't see this. They don't know what you know. So giving them some of this data and letting them know that their turn really is now. It might even be before Super Bowl, but it's certainly going to be right after Super Bowl.
It's picking up.
Yes.
It's picking up early. It's definitely picking up early. We were looking at about 2 shows per property per week last week. We're looking at about 12 showings to go under contract. So buyers are really feeling the crunch of inventory right now, and they're making quicker decisions in this market. That's similar to where we were 1 year ago, with people looking at about 12 homes to go under contract. Looking at where we are for median days on market, we dropped from 62.5 shows to go under contract, or 62.5 median days on market over Christmas. We're now down to 14 median days on market. And so what this tells me is that we've had this really active pool of potential buyers between 1 to 1.5 million. They've gone through and looked at all of the stuff that was on the market back in November and December. They didn't like any of it, and they were waiting for the new shiny listings to pop up as we got into the new year, and they're putting those under contract very quickly. So it's those new listings that are going under contract right now, but we've got some existing aging inventory out there right now. We've got about 29.4% of the homes that went under contract last week made price reductions, so very minimal price reductions overall when we compare it to other price ranges in this $1 to $1.5 million segment. And the average price reduction was large. It was 10.3%, which is about $143,000 off of the original asking price.
That's the old inventory coming off, though.
That's the old inventory coming off.
And if you did a price reduction, your days on market doubled. And that price reduction, you start chasing it down. So much better coming in fresh, coming in new right now with an appropriate price.
Yes.
It'll get bid up.
Yep, it sure does. So 1.5 to 2 million. This is 2.8% of our overall market. You can see it starting to turn red here as we start to heat up into the next couple of months. We dropped from about 3.3 months worth of inventory down to 2.4 months worth of inventory. Our average daily active count actually went up this last week. It's up by 4.8%, and our pending transaction count fell by about 25%. We're only putting 9 units under contract in this particular market. New listings were down by about 25%. And so again, our month supply of inventory dropped down to about, did I paste this in right? I wonder if I didn't update this graph, because this says 3.3, but over here it says 2.4. I'm going to think that I didn't update this portion down here. We're at 2.4 months worth of inventory in this market. Looking at the odds of selling, we're up to 37.6%. I wonder if I didn't update this either. I'm going to have to go through and redo this before I send this out to you guys. Looking at where we are for percent of balance, we're at 27.9% of a market in balance. Looking at where we were for shows per property, we're sitting at 1.4 shows per property per week. Shows to pending was down to about 14.9. Yep, I didn't go through and update these slides at the end. I'll have to go through and correct that. 14.9. I did. Well, I was doing it at 4 o'clock in the morning. That's why I didn't have enough coffee yet. I'm not used to being up this early yet. I'm still working on being a morning person. Looking at 42 median days on market, down from 66 the week before. Price reductions came in at about 46.2%, making price reductions with an average price reduction of about 8.3%, or about $180,000 off of their original asking price. So I'll go through and get those slides corrected for you before I send those out, and I'll get them over to my person to get them uploaded. And so we got a couple of questions. Can you clarify the odds of selling. The odds of selling is where I take into account all of the available listings for sale versus those that go under contract and or close during that given week. And I project it forward for a 30-day period of time. There's been some discussion that a balanced market based on past year's performance may actually be 4 versus 6 months worth of inventory. Thoughts? So I still stick with 6 because that's what the National Association of Realtors uses. And so again, that's the point at which the rate of appreciation matches the rate of inflation versus what we would think about as an average or a normal market. An average or a normal market would have about 3 to 3.5 months worth of inventory based off of the average from Denver. So if you're looking for an average market in Denver, that number is average. What is going to happen if interest rates go up at the Fed bidding February 1st?
Yes. The Fed rate will go up. It'll probably go up a quarter. So then it's a question of, do the interest rates follow? And if it goes up a quarter, it's exactly what the market was expecting. And I wouldn't expect our numbers to move. Really, the PCE comes out tomorrow, and then the CPI comes out in another 3 weeks. The inflation numbers are what's moving the 30-year fixed mortgage rate right now, not the Fed rate. Yeah.
Nicole, did you have a lot of refis earlier where people were really taking out a lot of their property? I heard this from one agent and appraiser. That would be my concern, but I have no knowledge of that.
We did not do a ton of equity extraction during the last period of time. With those low interest rates, we did have some if they were purchasing additional property and adding to their liquidity opportunities within the real estate market, right? To be able to take advantage of leverage. So we saw some of that. We did help people cash out refinance specifically to purchase other properties, which also appreciated during that market. But we didn't see a bunch of people like taking it out to buy ATVs or boats or recreational vehicles like you would have saw during the housing bubble. Will you please comment on attached under 500,000? Is it warming up as well? Yes, that market has been very much so on fire with the exception of Lodo. In Lodo, we have about 4.5 to 5 months worth of inventory right now. So if you're outside of Lodo in that attached market under $500,000, it is definitely picking up out there. Huge increase over last year. I'm not sure what that's in reference to. Eric, you're gonna have to expand. Yes, please do. Sorry, I missed it. Can you share again current days on market for 500 to 1 million? It was, let me get to that slide really fast. It was 0.8, if I remember. Oh, days on market. Days on market. I think it was 44. I was thinking of months of inventory. 43 median days on market for 500 to 1 million based off of data for going under contract last week. And what was the average price reduction for 1.5 to 2 million was about, it ended up being 10 point, nope, that's the wrong one. It was an 8.3% price reduction overall for the 1.5 to $2 million price point. So just getting a couple of thank yous in here. We'll answer those, say thank you. You're welcome. It's our pleasure to do it. And we'll get you guys kicked off with Nicole so that she can share with you what's going on with the economics this week. Well, let's talk about that. So what is happening? So the Fed is meeting next week. So that's definitely something that you're going to want to pay attention to. But let me get this going because I can't talk and do the at the same time. All right, here we go. All right. So talking about, okay. I think we're going to see it here in a second. All right, you've got my slide deck. So let's talk about the economy. Let's talk about interest rates. Let's talk about first-time home buyers. And let's talk about an income increase coming from CHFA. I mean, every good news that I can bring you about first-time home buyers, especially right now, I'm going to announce it from the rooftops. They are my passion. So we're going to step into that at the very end, and we're going to talk about opportunities that you have to get more of those first-time home buyers into a home and get around the affordability issues. But as a reminder, next Thursday, we will not be here. We will be at the next big thing. Make sure that if you have not bought your tickets yet, that you do that. I know we've seen a nice uptick in tickets, so it is going to be a full room. And the energy level when it gets like that is so off the charts that that's exactly the way you want to start your year. Of course, remember, it's right downtown. Valet is included. All you got to do is get dressed. I mean, shoot, wear the bunny slippers. I don't care. Bring them on. Are you going to have blankets again this year? Yes. Yeah. Blankets, goodie bags, all the things. Yeah, and coffee. Plenty of coffee. We learned our lesson last time. Yes. We didn't fully stock. We've got it fully stocked this time. And as a reminder too, I have definitely talked about this. I don't know that I've talked about it enough. The next big thing is not a profit generator. In fact, it's a loss leader. And I do it because I'm so passionate about kicking off the real estate market in this way and with this energy, bringing these speakers around from around the country into Denver. But the money, any profitability, and if there isn't any profitability, I actually write a personal check because my husband and I have committed to contribute every year. But this year, our group that we're contributing to is Project ICU. And you know them and I adore them. And they're all about helping single moms get into home ownership. If you don't know Project ICU, you should check it out. You can sponsor a woman and her family in getting into a home for $10,000. And when I think about the commissions that we earn, and that can change the entire life of an entire family into home ownership with one commission, that's game changing. And that's something that you really should put on your bucket list for 2023. So come learn more about Project ICU. All right, so the 10-year is trending down. It doesn't mean that it's going to go straight down. It doesn't mean that our interest rates are going to drop to the bottom. It just means that we're seeing benefits of inflation slowing down, which I'm going to show you in a minute, and that we're seeing this trend. I like the trends. The trend is your friend. Today, we're seeing a lot of mixed news cycles, so it's moving around a little bit, but we're kind of watching this trend. The problem is we're having a really hard time breaking this 200-day moving average. As you can see, it's bumped along this 3.4 for over a week now. So we just keep bumping into it, and we're doing the same thing today. Once it breaks through that and stays there, because it broke there for just a minute, you can see it, the little tail right there. It broke through it and then it popped right back up again at the end of the day. But if we break through that and stay there, that's when we're going to start to see those interest rates start to settle down into the next tier lower. But those little movements is definitely having an impact. We saw a massive jump, 25% the previous week, and then 3% more mortgage purchase applications last week. So we had 25% more than 3% more on top of that. I mean, we've been hanging out down here since November. It jumped us all the way up, not to normal yet. And still year over year, we're still down 39%, but this is phenomenal. If this continues, we're seeing it, we're feeling it, right?
Yep, we're feeling it.
This is the buyers.
I'm encouraged.
Yes.
I was pretty downtrodden towards the end of 2022 because the market activity just died as we got into the holiday period. But now with the pickup going early into 2023, I'm feeling more optimistic than I was towards the end of the year.
It makes your heart happy.
I did not like I'm a positive person. I did not like being negative about what the outcome was going to be for this year.
Right.
It was hard. It was hard. It's not fun stuff to talk about.
I agree. And it's not all roses and ponies, right? I mean, we're still going to have moments where we're going to get some bad news. The market's going to slow down. Maybe the buyers close up for a second. Maybe there's too much buyer demand and there's too many multiple bids. And now the sellers have the advantage again. I mean, throughout the year, we're going to have that on time every week, the update that's going to give you that pulse check. Because when you're relying on reports that are from last month or the month before that, like the national reports, it doesn't quite tell you exactly what's happening. Why the jobless claims report is so vital, why this report is so vital, because they're weekly, they're a pulse check on what's really happening. So the mortgage purchase applications jump. My goodness. And remember, nationwide, 28% of all homes are purchased with cash. And I know we see that upper price point, 40% is purchased with cash here locally, but nationwide, all price points, 28%, they're not even included in this number. So to see this jump and then to know that that's on top of it, this is certainly the activity we've been waiting for. You've got to be mining your database. You have to be having those conversations that keep you relevant, and you've got to make sure that you're leaning in exactly where your client is. Right? Not trying to pull them from where they are. If they're not ready to hear it, move on to the next person, because there's a lot of people you can help right now, given where we are in the market. All of this is good news based on inflation. The 10-year's dropping with inflation. The 30-year fixed mortgage rate is going to continue dropping as inflation drops. It's really the PCE, which is coming out tomorrow, which I would expect was probably going to be where we expect it to be, because we've already seen a hint. The CPI was on the same month's data already, and we got it out. So the PCE, if it does move the markets, if you're not on our Friday market update text, you might not know, but we will definitely be letting you know if you are on the Friday market update text. And that number, because I keep getting reminded that I have to share it, is 855-930-0377. If you do want to get on that, you just update to that number. All right, so if inflation is dropping, so we're watching, we've clearly come off the peaks of both the headline and the core substantially. We've dropped almost 3 points on the headline, and we've dropped a point on the core. So we're going to keep watching that. The big number is shelter. So if I look at the blue, December year over year, shelter is still higher. Now, I know some of these numbers are longer, they seem more extreme. Fuel, yes, but it's coming way down. As you can see, it's been stair-stepping down. Gas is a little bit there, but gas futures are already down. So that number is going to come down in the next inflation report. Shelter is that lagging number that isn't doing what the reality says it should be doing. And it's propping up inflation because it's such a huge fraction of the overall inflation number. So we know housing prices and rent have been coming down, yet the CPI measure of the owner equivalent of rent, which is what's pulled into that inflation number, is still on an upward trajectory. So it's not correct, it's dated, which is keeping the inflation number up. We know, we got a trailer to the movie is what it is. Like, we know where it's headed. We know it's gonna come down. It's going to start dropping that inflation number faster. So then why are we continuing to raise the Fed rate? We know with pretty high certainty that we've got two more. We've got this one next week, which will go up a quarter. And then we've got another one in March, which will go up another quarter. Unless there's some big news that says that they need to raise it maybe 50 bips, but the intention is to raise it a quarter, and then hold it there for a period of time. And the big reason is the labor market. We've had 21 consecutive months of negative real wage growth. And I was actually talking about this yesterday at the Berkshire meeting, is that this wage cycle is this constant getting, so employers have to hire somebody because we have 1.7 job openings for every unemployed person. So they're trying to engage that person looking for a job into their job, secure them with higher wages. I have to pay you higher wages, so I have to increase the price of my services or my goods that I sell to the consumer. Well, that employee is also a consumer, so they're paying the higher prices, so they have to get a higher wage. It's a wage spiral. And that's what the Federal Reserve is trying to put a stop on, is this constant wage spiral. So we're seeing a lot of layoffs. We're seeing people lose their jobs, but they're not going on unemployment. They're getting new jobs. And in fact, something just came out this morning that one of the largest Paychecks, one of the largest payroll companies, went through and increased all their wages. Oh, I was like, that was just to hold on to people, right? So everybody's trying to hold on to the people that they do have. So this is just going to continue to be a conversation, and it is really the thing that's holding up inflation right now. So, but at some point, it's going to land in a recession, and we hope it's as soft a landing as it can be. That recession for us in the housing market isn't as bad a thing as it is for the overall economy. Of course it is. That recession just simply means that consumers are feeling tight. They don't want to spend the money. They're staying home. Home becomes important. The interest rates, the inflation comes down, the interest rates come down. All of a sudden, I'm going to start spending money on that home. So these are not necessarily bad things, but it is the economy in which we're living. And it's certainly the story in which your buyers and sellers are living. So being aware, is their job stable? Asking them, how are you feeling about the economy? How is it impacting you personally? Being empathetic in a time like this, especially with all the negative media. I mean, this is where you can really shine as being relevant to that client in an empathetic way to build the relationships, is talking about what is happening around them and how it's affecting them. But right now, this 2 and 10 year inversion is an absolute 100% clear sign that we will go into a recession. It happens every single time without fail, and it is a 100% certainty indicator. So we are going to head into a recession. If they keep raising the Fed rate, we'll go there. But the market doesn't believe them. I mean, that's why our interest rates are coming down, even ahead of with the Fed raising the Fed rate. That's why the stock market celebrates everything, because we keep thinking that they're going to raise it up. They say they're going to hold it there for a long time. But interestingly enough, this blue line right here is where the market perceives the Fed rate to go. Now, right now, we're at 4.25 to 4.5. And this is putting us at 4.75, which is estimating the quarter next week and the quarter in March. And then look at this. It only expects to stay there through June. And then the market anticipates it's going to come down starting in September. Now, the Fed and Powell have been saying it's going to stay there for an extended period of time. And the market is saying, I don't hear what you're saying. Say it louder. They're not listening. We don't care. The stock market is having its rallies based on information. Now, I know overall, I'm not feeling particularly fantastic about my stock portfolio, but we're having days where we're rallying based on inflation numbers. We're certainly having the 30-year fixed mortgage rate and the bonds are meeting kind of they've come off of their peak, which is fantastic news. We're going to just keep watching this. We're watching where the expectation is, where the market actually starts to line up with expectations. Does the Fed continue to hold it there? Does that in turn put the clamp down on this wage spiral, which in turn affects inflation, which in turn drops our interest rate, creates demand, and gives us a real estate market that we're all used to? I mean, this is all important to understand. Not expecting anyone to be an economist, but certainly understanding the factors by which impacts your industry. It's your industry. And so how are all of those things impacting it? It'd be the same thing as if I was a factory worker and all the price of plastics, and all of a sudden I started losing people or people started moving out of my town. I mean, you just have to know the things that impact the job that you do on a daily basis. And for you to take advantage of it too, for your own personal wealth development, identifying those opportunities in real estate where they're still continuing to add value to grow in appreciation and cash flow. All right, so the job market. The market might be getting a little bit ahead of itself because the job market is saying, no, yeah, we're not slowing down. We're just fine, is what it is. Job claims dropped 6,000. It's not getting higher. We're continuously seeing more layoffs, and they're not staying there. Now, if somebody's been on unemployment, it upticked just slightly to say continuing claims that those people who have been on unemployment now for a while are getting a little stuck. Those people who get laid off, find another job, and never touch unemployment are finding one right away. Those who are getting stuck in an unemployment cycle are starting to get stuck there. So that's the goal. Don't get on unemployment. So the GDP also jumped. So that came out just this morning. GDP for the fourth quarter last year jumped 2.9% if I annualize that number, after the third quarter being 3.2. Now it slowed down just slightly, but it's still elevated. And the crazy thing about this is not only is consumer spending still strong, in fact, we saw consumer spending on goods jumped 1.1%. Consumer spending on services slowed slightly, but it's still up by 2.6%. You know what's back? Cars.
Cars?
People are buying cars. So that's the biggest thing about this is durable goods. And the biggest thing in durable goods is cars. So durable goods, think about your washing machine, your cars, those big household items all land in durable goods. And the durable goods orders, new orders, were up 5.6%. Now it was down last month and it's been barely up. So to see 5.6% on durable goods orders, I mean, here I was thinking that we were getting a slowdown on our Amazon shopping.
What is
Maybe
this?
you can't deliver a washing machine. Everybody's buying cars. So check this out. So vehicle sales are expected to increase in January. That is really high. That is, in fact, it's higher than it's been since, how long ago is this? January 2021. Please, for the love of man, don't buy a new car next month. We just need the GDP to slow down. We need to see retail sales already dropped. Retail sales is the stuff that you order from Amazon. Retail sales was down 1%, but durable goods is up 1%. So they actually, it's so interesting to me to see this. So this is that whole force against what the Fed is trying to do, which is by raising the Fed rate, increase the cost of borrowing, increase the cost of spending. maximizing your savings, put it away, stay home for a couple months, don't spend. We just need 2 quarters of consecutive GDP decline. And we're not getting it quite yet, but we're heading towards a recession. We're not heading towards a recession. We got a lot of mixed signals, but people that have money are still spending the money. So back to good news. The delinquencies are still low. We're seeing that here.
We had 3 last month.
3
Total closed transactions that were distressed last month out of nearly 3,000 closings.
Yes, 3. All right. So it's just not going to happen. In fact, so a good friend of mine brought it to my attention. He goes, hey, I heard from another lender. It's like second, third hand removed. He said, I heard that Chaffa's got 400 foreclosures lining up. So of course, I got a hotline right into Chaffa and I said, can you tell me what's going on here? She's like, absolutely not. We actually call, if you have clients that have a Chaffa loan, we call them and we know where all the money's hidden.
Mm-hmm.
We'll find all the support and all the help to get somebody out of a foreclosure situation.
Mm-hmm.
They don't want to foreclose on a single person, but I'll tell you what Chaffa's doing right now. They're cleaning up their books. And all of those homeowners who use Chaffa to buy a primary home and convert it into an investment, when you convert it into an investment, you're supposed to pay off the second.
Oh,
so that's probably there's
the
some
note
letters
too.
going on. Yes.
Oh,
So you are supposed to pay off the second when you convert that home that you did buy with a Chaffa loan as a primary into an investment. The idea is that you pay that off. Now, there might be some letters going out in the mail asking for that second to be paid off. You can stay with the Chaffa first, but they are looking for their money back to pay for, to support additional first-time home buyers. So just know that they do want to help you. If you are in that home, they do not want to foreclose. In fact, one of the good news that came out of that conversation, she gave me a tidbit. This news isn't going to be announced until Monday. You guys are getting it today. Chaffa is actually raising their income limits, and it's substantial. Right now, if I go to Arapahoe, which is one of the main counties here in Denver, all the main counties look exactly the same. Our income limit for a conventional loan is $94,000. FHA, it's 117 if you have 1 to 2 people. We're going to rate, or Chaffa is raising that to 148,000 on Monday. That's a big difference.
that's a huge jump.
That's huge for, and you don't have to be a first-time home buyer. You can actually sell a home and buy a home and get a Chaffa loan. It's not about being a first-time home buyer. Of course, the access is to help first-time home buyers get in, but you can be a move-up buyer and still get this. So if your income, your qualifying income, not your household income, massive distinction. What we put on the loan application to qualify you for is what goes into this number. So maybe it's just one of the spouses instead of both getting access to some of this money. MMA is another one. So Metro DPA is another one that we use a lot. They have an FHA limit higher than Chaffa of $176,000. So you can have $175,000 income, get an FHA loan if you don't have another home, and then you down to a 640 credit score and get up to 5% down payment assistance.
Wow.
It's a big deal.
That's a huge deal.
This is a big deal. So we need to be talking to our first-time home buyers right about now. MMA also has the social equity program where they are giving $15,000 or $25,000 to those people who are in these red-lined districts. So specifically, this social equity program is targeting residents or descendants of residences. And we've done a number of these already, and they're all descendants of past residences who lived in one of these red areas from 1938 to 2000. So this is something, again, if one of these red areas is an area that you typically work anyway, you should be asking your target market or your database, if you still live or have descendants that lived in these areas, we can give you access to $15,000 to $25,000 depending on your AMI, the area median income. If you're 80% or lower, you get the 25. If you're 80% to 100%, you get the 15. Still, that's a grant. If you live in that home for 3 years, that grant is waived. If that's not a marketing opportunity, I don't know what is.
That's great.
Right?
That's great.
So these are all the things that we want to really hyper focus on those first-time home buyers who have been out of the market. So let's see if we have any questions. I know we're coming right up on 11. Oh, we did it. Oh, Brett has a happy heart. I love the happy heart. Me and the kids. Can you repeat the Friday update number? It's on my sticky over here. 855-930-0377. And we'll definitely be letting you know what happened with the PCE tomorrow morning.
What about oh wait, we did that one. What about the attached market just outside of Lodo, just west of I-25? Once you go west of I-25, it picks up quite drastically as you get into Low-High and Highlands. So that's a really interesting market right now, where we are looking at net less than 1 month worth of inventory in that market right now. And so that market is pretty hot right now. Yeah. When did you see the inverted yield curve beginning to correct?
Oh, when do it started to
it?
invert back in October, and and a recession usually happens. The average recession period is 24 months after it converts for the first time. It could be a lot sooner than that, but so it could happen anytime this year, could even happen the beginning of next year, but it will correct as soon as we enter into the recession.
Yeah, so the total inventory right now is about 4,200 homes available for sale. What will the social equity and CHFA maps be included in the report?
They'll be included in the PowerPoint presentation that I upload into the Agent Ignite Facebook group. And you can absolutely, so they're not included in Megan's email that she sends out in her reports, but we will have them in mine, which is in the Facebook Agent Ignite group.
Does the descendant program require you to buy in that neighborhood?
It does not. It just requires that you're a descendant of that neighborhood.
Social equity program. Can you send us some information on this, please?
I will.
Can you explain why May 10th numbers will be important?
That is a longer conversation since it's 11 o'clock, but it has to do very quickly. It has to do with the CPI, the inflation numbers. We're both the headline CPI and the owner's equivalent of rent. Sorry. So the owner's equivalent of rent was high, and the CPI headline number were both high 1 year ago. So the 1 year comparison of year over year compared to last year to this year, if both of those are high and it comes in low this year, it's going to seem even lower because I'm comparing it to such a high number. So that spread is going to give us a percentage drop, which is then going to give us that year over year inflation drop, which is then going to excite the markets, and we're going to see that 30-year fixed mortgage rate drop.
Awesome.
Yes.
Well, that takes us right up to 11 o'clock. We're going to thank you guys for your time. As always, thank you for joining us. We had nearly 1,600 people on the call this week, so thank you for joining us. I just added a whole slew of new people that have been invited, so we'll see those numbers continue to rise as we get into our spring months. We won't be here next week. We'll be at the next big thing, so make sure you get your tickets, and then we'll return to our normal Thursday updates the second week in February at 10 o'clock. So I'll get those registration links out to you in the email today so that you guys can register for those upcoming meetings. But as always, we thank you for your time, and we certainly hope that you keep me in mind for for title insurance with First American Title and Nicole Ruth with One Trust Home Loans for your buyers, and if you need a lender. If there's anything that we can do to help you out, don't hesitate to reach out, and we will see you guys at the next big thing. Have a great weekend.